By the way, if you have children and they're still living at home, don't feel bad. 32% of them are, even with a bachelor's degree, they're still living at home. So, you know, there's a lot of people there. And over 60% of us boomers are supporting millennials to some extent every month, whether they have a job or not. So you're with the majority of people if your kids have not quite moved out of the basement yet, even though they have a job. I know a surefire way to get them to move out, by the way. You buy them their own house. They won't pay rent, but they will move once you do that. It's guaranteed to work, preferably in another city. Okay, let's get to work then. This is our accuracy rate from last year. For those of you that are new, I start with this because I think it's really important if you're going to believe the forecast going forward that we at least take 10 seconds to look backward. Again, if you're new, the duration column is how long the forecast was in place. The accuracy column is how well did the forecast work out, and how long the forecast was in place as of December 2015. So 2015 was a good year for ITR Economics. So was the year before. The methodology works, and that's all I'm going to say about that so we can get going. For those of you in the back, this is an eye chart, but NAED will make this available to you. My point here, as you find your home state and see what size your state is compared to another country, my point here is that the United States is a huge economy. We are the world's largest economy. And I want to make sure you get that, because 53% of America, according to a Gallup poll, thinks that China is economically larger than the United States. It's just not true. We are 70% larger than China. So just understand that we are a huge nation, and our percent of the world's GDP grew from 14 to 15. We're on a growth path, not a declining path as a nation, and there's a lot right going on. You're going to find that I'm going to be telling you a lot about what's right in our country right now, so that you'll have an optimistic view of the future. Here's what I'd like you to take away from today. My gosh, I should be planning for a better future. It doesn't matter who's elected. Next year is going to be a better year. 18 is going to be a good year. We're going to have a recession in 19, and then we're going to be back into upside activity in 2020, 21, and 22. So if really all you want is the next 5 years, I just laid it out for you, and life is good. 17's good. 18's good, especially the first half. 19's a mild recession led by the consumer. So if you're tied to the consumer and what you do, you're going to feel some pain in 19. That's only partially tied to politics. It's more tied to consumer behavior, which I'm going to show you. This is the U.S. economy right now. The rate of growth for industrial production is below year-ago levels, but that's on the back of mining, and that's being driven by metals and minerals as well as oil and gas. And the oil and gas we're going to concentrate on in just a couple minutes. If you're not tied to the mining side of the economy, then you want to pay attention to GDP, which is the orange line. That rate of growth for GDP has stabilized. It's a rate of growth you can live with. It's a rate of growth that says there's economic activity out there. When you hear somebody say, and I don't know if you do this internally or not, that this is a tepid recovery, I'd like you to correct them. This is not a recovery, this is growth. We're at record high GDP. We're at record high consumer spend. We're at record high employment. We're at record high job openings. We have wages that are in some areas that are at record high levels. This is a growth economy, and if you think growth versus recovery, you behave differently. You start taking on some risk. You start assuming that you should be getting ready for expansion. When you think recovery, then you're afraid of tomorrow. Understand this is a growth economy, and it's going to be a growth economy for quite a while. And one of the reasons why it's millennials. I don't see a lot of millennials in the room. Let's be frank. Sometimes they're hard to understand, okay? But they are people at the end of the day. And they're a lot like us in a lot of respects. We're going to talk about millennials for a few minutes today, but the millennial population in the United States is a huge factor in our strength going forward, as is our energy position. We'll get to all of that. I want you to note the annotate, which you probably can't see from the back of the room, and that is that manufacturing in this country is picking up speed. The rates of change have moved up. The monthly data trend is rising. It's seasonal and cyclical because the rates of change are going up. Manufacturing is gaining strength once again in our country. Our forecast for industrial production has changed since the last time you saw us. It has changed because there was a data revision by the Federal Reserve Board, and it has changed because of mining and its impact on overall industrial production. But the reality is 2017 rate of growth is the same as we were talking about a year ago, 2.7%. 2018's rate of growth hasn't changed either. It's just the near term has been downgraded because of that data revision by the Federal Reserve Board and because of mining. Perhaps more importantly to you is GDP. And on the right-hand side, you can see that GDP is tracking as we have been forecasting. This forecast has been in place for over 6 months now. The left-hand side, you see nothing but growth. The economy is going to continue to grow and grow and grow, despite all the concerns about Washington, despite all the rhetoric, despite all the left versus right and all that sort of stuff. The economy is going to grow through this time period. To perhaps answer a political question up front, we know at ITR Economics that a new president wants to, and same as you, wants to pass a major piece of legislation within the first 100 days. It's a way to make their mark in history, blah, blah, blah. If it's economic in nature, and most things are, that means we're talking somewhere in the, towards late spring, maybe June, before a piece of legislation is presented to Congress. Then Congress has to vote on it, assuming that Congress does a quick turn into a June piece of legislation. Our studies show that it takes 18 months before that legislation impacts the economy. So from the middle of June 2017, you're at 18 months, then we're into 2019, late 18, early 19, before we feel the economic impact of a new president. So my forecast here behind me holds no matter who's elected, because it takes time to screw up the economy, or it takes time to enhance the economy, depending on your point of view. But in either event, it always takes time. And if you remember that I mentioned a recession in 2019, that means that the next president is going to be tagged with that recession right before another presidential election in 2020. So whoever's elected president is likely to be a one-termer. Should make you feel better no matter which side of the fence you're on that one. It's one and done, all right? It's not a bad motto, and then we can get back to business. Okay. Let me dust this off really quickly. I don't want to spend a lot of time on it. Hopefully you're familiar with it. Rate of change is where we're headed with this. This is the backbone to what we do at ITR Economics. We take a monthly data trend, we smooth it out to a 3-month moving total, 3 months added together. We compute that on a monthly basis. We do a year-over-year comparison on a monthly basis to get a quarterly growth rate, a 3/12 growth rate. That's part of our forecasting kit. We also smooth out to a 12-month moving total. The 12-month moving total on a year-over-year basis renders a 12/12 rate of change. That's a 12-month growth rate. And in this particular example, we see that the rate of growth for this company is slowing down. There's only 4 reasons why you slow down. There's only 4 reasons why you speed up. And once you identify the reason, you start making decisions based upon what's happening to you. My goal is to see around the next corner. So we help with the decision-making process, but we also want to make sure you see around the corner. And using 3/12, 12/12, and leading indicators, and I'm going to show you a bucket of those today, you get to see around the corner. The 4 reasons, by the way, real quickly, is it's the economy, it's your industry, it's a black swan event, or you've screwed up. Those are the 4 reasons why your rate of change goes down. And the screw up, we all do it. It's just management made a mistake. Bad marketing, bad product, bad placement, bad whatever. And this will tell you what is going on. All right, now that we know rate of change, let's compare the industrial production index to the wholesale trade of electrical and electronic goods. And what you see here is a strong cyclical identity. What you also see here is that that orange line has stopped declining before industrial production. That's because most of you are not in mining. And this wholesale trade designator is not tied all up in mining. So we're seeing some improvement already in the wholesale trade industry for electronic goods or electrical goods. When we go a little deeper into this, we see that the 3/12 rate of change, which is the top orange line, has actually started to move up. What you cannot see from where you're sitting, because it's just blended in with the black line, is that the 12/12 rate of change is also started to move up. They both have established tentative lows. We have a record high amount of money being spent in this industry. The rate of growth has stopped. That's the bottom blue line. But it's at a near, just off the November 15 record high. What disturbs me the most about this is the bottom orange line, which is the 3-month moving total, terms we just described. The 3-month moving total is dropping at the fastest pace we've seen in 24 years. That says that we have some more problems to go through the near term, that we're going to see that the industry as a whole go flat to perhaps even mildly negative for a couple months, but it's not going to last long. I know that because I look at the 3/12 and I see that's beginning to move up. I look at the February result, and it was the best February since 2010. I look at the leading indicators, which you haven't seen yet, and I say to myself, we're going to see a nice turnaround in this industry in the second half of 16, so that 16 as a whole ends the year 3% above 2015. So plan on a 3% growth for the industry as a whole. 2017, you can see I'm forecasting a very strong 13.2% rate of growth. That 13.2% rate of growth is something that may be hard for you to believe at this point in time. I'm going to show you why I'm thinking that. I just wanted to get the forecast out there. The economy is going to be expanding, consumers are doing well, the global economy is settling down, and you're going to benefit from all of that in 2017. So you have to ask yourself, are you ready for it? Do you have the people, the process, the equipment, brick and mortar, everything you need to be that kind of busy in 2017? If you're selling into the medical industry, medical instruments production does not have a tight cyclical identity to the U.S. economy. You can see that by this comparison. But you can see that the orange line is moving up. So selling into this industry is a win. We're 0.3% above year-ago levels. On a dollar basis, it's moving up. On a production basis, we have the steepest rise since 1970s. We have the rates of change telling us there's going to be more upside momentum. So selling into the medical field is good business as you go forward. DME providers are facing margin pressure because of reduced reimbursements coming out of Washington and then by the insurance companies as they follow along, but we're still seeing an increase in production. So as you have price points you need to worry about, you're not going to be worried about a demand function in the medical industry. When we look at electrical equipment production for the manufacturers that may be present, the rates of change are positive. They're not going to weaken dramatically, but you should just look at that top orange line and know that the rate of rise is going to slow a little bit through the near term. The bottom blue line, which is the amount of production that you were involved in, if you're a manufacturer in the room, is on the way up, but it's at a milder than normal pace. It's going to stay milder than normal. We're going to see more of this long-term flatness than anything else that's been going on since 2012 in terms of the amount of production through the next quarter, maybe two. The latter part of this year, we're going to see a bounce up because of increased demand. And first half of 2017 is going to be strong. Second half of 2017, you're going to see the rate of growth, the rate of demand for your product ease, so that 17 as a whole ends up just 2% above 16. It's up and it's up. Just understand that from the fourth quarter of 16 through about June, maybe August 2017 are your strong periods, and then things are going to slow down a bit for you after that. If we go a little deeper with the NAICS code, we find that electrical lighting equipment, the rates of change are good. The amount of production going on is good. We have a mild rate of rise in the bottom blue line, but it is going up. And typically, once a recovery or growth trend resumes in this industry, in this case it is recovery, it should last until about the middle of 2018. No, don't be sorry. I just don't want you to trip on. Okay. If you're into electrical lighting, your world is good. It's going to continue to get better, and I suspect you're going to enjoy the next 2 years as you look at this industry. Unfilled orders are climbing 1.7% above year-ago levels on a 12/12 basis, 7.3 for the quarter. All that means that there's more demand coming, and you're going to need to produce more. As you produce more, you're going to need more of the factors of production, which means that you're going to be managerially taking on some risks. I think it's very measured risks, and you should be anticipating more and more demand for the next 2 years. Let's talk about oil and gas industry, because that affects a lot of you in the room also. This is a relationship of inventories to price. Inventories being in green, price being the blue line. And when that bottom blue line moves up, that means there's upward pressure on pricing. Usually that occurs when inventory levels go down, but on a rate of change basis, we're not there yet.